Well, we're going to take a look at how we're trading in the ag commodity markets on this Monday with a little extra help, as Tim mentioned, from Chris Swift of Swift Trading Incorporated, based in Nashville, just down the street. How are you doing?
I'm doing very well. How
Happy
are you
New
this
Year.
morning? Thank you. Same to you.
Gosh, I haven't seen you for a year.
Yeah, it's been that way, hasn't it?
All right. Well, let's dive into this thing,
Right.
and we'll take a look first at the grains, and then we'll get into livestock here
Sure.
in a couple of minutes. All right, on the grain side right now, not much going on. Corn just kind of drifting, if you will. It's showing March corn down a half at 386, so not a lot going on here. Let's move on to the soybean trade. In the soybeans, we now have that March contract. It's now trading 1 3/4 higher at 943 1/4. Keep in mind that January is now in delivery, so really no one trading that except for people that actually want the physical commodity here. Let's take a look here at how the wheat market is trading this morning. And currently in Chicago wheat, a lot of pressure here, Chris. We have the March Chicago wheat down by 5 1/4 cents at 549 1/4. That's off its overnight high by 6 cents now. That's kind of intriguing. Let's look at Kansas City wheat. And Kansas City wheat on the March is not down that much. It's down 2 1/2 at 472 1/2. I was just checking Minneapolis. It's down 2 1/4 right now at 545 1/4. So a lot of weakness in the wheat market as opposed to what's going on in the soybean trade today. How come?
You know, probably not much of any difference there. We noticed that the export numbers on Friday that came out were not really good for anything. We're all looking forward to Friday's WASDE report to see what the USDA is going to tell us or not going to tell us about this year's crop. And just coming off of the holidays, there's not been a lot of cash business to have taken place either. But first of the year is here now, and we got our first full week of trading. And I have a feeling you'll see a little volatility come into the markets, and especially since we've had some issues overseas, that will make everybody a little bit pay a little bit more attention to the markets.
You know, we were talking about this last week. How in the world is USDA going to come out with a supply and demand estimate when you project out a year as far as what the carryouts will be on the grain when we don't really have a clue what the demand is going to be? It could be stellar. It could be,
It could be. It's best to understand USDA is only going to report what they know or what they have been told through their surveys. So when we as commodity brokers or traders, we look for the anticipation of certain factors to take place. They don't. They're just going to report it just as it comes out. So in my opinion alone, I believe that until we see some really heavy demand for the market, that will begin to peel away some of the layers that we can't actually see, nor can actually USDA see. But a little bit of demand would expose any kind of issues that there really are out there.
I saw where the dollar was opening a little lower this morning. I just wondered how that fits in the overall picture here to maybe pull in some foreign demand that has been missing for a while.
It's very beneficial. There is no doubt whatsoever. The length of time that it takes, some countries may not be ready to purchase any corn just yet, so the difference between where the dollar is now and where it may be in other parts, but they can always hedge it. They can always lock in that currency risk if they have any, and then be able to purchase the corn when they need to from there, but they're already hedging the risk. But the dollar's been weaker here recently, and it's starting to show some aspects of trending lower now.
Okay, a lot to talk about on the livestock side too, and we'll pause right here, and then we'll come back in just a moment, and we'll talk more with Chris Swift about cattle, hogs, and the stuff surrounding it when we come back. Well, welcome back, and we're talking with Chris Swift of Swift Trading Incorporated in Nashville. And we're going to turn our focus now over to the livestock side here as we get rolling here on a Monday. Let's look at that live cattle board. And when we looked at it earlier on, we were higher, led by the nearby contracts. We are still led by the nearby contracts, and we're actually firming up across the board now. So we currently have February up 85 cents at 125.58, April up 73, and you get progressively less to the upside as you go further out. On the feeder cattle market this morning, we currently have the January up $1.55, Chris. We have March up $1.22. In fact, all the months are now over $1 higher. So they're kind of taking the spurs here to the cattle market in the early going. Let's look at our hog market. What's it doing? Well, they're trying to follow, but can't quite get it done. February is now turned up by a nickel at 68.60 after a lower start. We have April still down 20 at 74.95, but they're mixed. So one thing I wanted to point out, the new U.S. Pork Packer Margin Index, we have that. This is based on calculations done by the Wall Street Journal using a wealth of information here, but They calculated pork packer margins were running $43.90 on January 3rd. That would be down a little bit from the January 2nd number of $45.15. So that trended lower here on the last day. How does that compare to how the beef packers are doing? Are they making pretty good money yet, or what?
They are still making. They have not stopped making good money. It has fluctuated quite a bit, and they've lost a lot of margin because cattle prices have gone up now, and beef prices haven't gone up much anymore. And actually, the carcass prices dropped off since the rib dropped off. But yeah, they've lost a lot of margin from the big swell that they had this past fall. But it's still very profitable being in the packing business.
And that really ramped up after that
the fire. The fire. That's exactly right. It was a very extraordinary case that we've had.
Yeah, so things have been kind of easing back as far as the
Very
margin
much so.
Since then, but how is that impacting the cash cattle trade now?
Well, we've been stepping up every week. We traded 124 last week for cash cattle, and we've been just a little bit shy of inventory simply because of the September and October placements were so low. We had, August, September placements were so low. October, we started building up a little bit. November, we started building up a little bit. So we should have additional inventory coming in after February. But right now, just because those August, September placements were low, we're just probably a little bit shorter of cattle. We got 102 on feed, and we're not marketing a lot, but we haven't ratcheted up into 104, 105 areas again. So we've been keeping it right around 100%.
And during the break, you were talking about the upcoming, we have a cattle inventory report at the end of this month,
That's
right?
correct, at the end of January.
And you look for what?
Probably about a 1% decline. I think with the increased cow kill, the increased heifer placement, it would be very hard to have expanded in 2019.
Okay. Well, thanks for explaining all
Sure,
that.
absolutely.
Kind of got a little in the weeds there, but
always a pleasure to be here.
Deep technical stuff. I appreciate your analysis.
Absolutely.
All right, Chris Swift of Swift Trading Incorporated right here in Nashville. So always a treat.
All right, as always, thank you, gentlemen, very much.